Welcome to NTD Business. I'm Don Ma. S&P 500, NASDAQ fell on Thursday. They're weighed down by drops in Tesla and Netflix following their quarterly results. But the Dow advanced for a ninth straight day thanks to gains in Johnson & Johnson following a strong annual forecast. Tesla's shares tumbled after the electric vehicle maker reported a drop in its second quarter gross margins. More on that in just a bit. Netflix also stumbled after the streaming video company's quarterly revenue fell short of estimates. S&P 500 lost 30 points, or 0.7%. NASDAQ lost 291 points, or 2%. The Dow rose 163 points, or 0.5%. Economic data on Thursday indicated the labor market remains tight, while the housing and manufacturing sectors continue to slump. A historic heat wave is intensifying across the globe, causing serious economic and health implications. Here's more.
There are going to be massive impacts that will only eventually show up in employment, GDP, public health statistics.
As more Americans crank up the AC, it is projected that home energy costs are going to increase this summer. One analyst expects costs to jump nearly 12%. In some areas, low-income families who don't have this option could face potentially fatal temperatures. For workers in weather-exposed industries, federal safety rules do require employers to provide workplaces free of known safety and health hazards, including the heat. Target has changed its dress code to allow most employees to wear shorts and says other policies for those working in extreme heat include water and rest breaks.
There's sort of high-tech or low-tech ways of adjusting.
Climate economist Gernot Wagner says when the temperatures get this high, the bottom line is always going to be impacted.
Productivity through the economy goes down, especially when we hit certain thresholds.
But the primary concern remains on the health and safety of workers.
At the end of the day, extreme temperatures literally kill. That, of course, is the ultimate impact.
Dozens of deaths this year are being investigated as potentially heat-related in Maricopa County, Arizona, where a new record was just set for the most days at or above 110 degrees.
Now, it's a very confusing time in the economy. The market is rallying, but there's still a lot of indicators out there that show a recession could be coming, even though this widely expected downturn has yet to show up. And speaking of economic indicators, an index designed to track turns in U.S. business cycles fell for the 15th straight month in June. This is the longest streak of decreases since the lead up to the 2007-2009 recession. The conference board on Thursday said its leading economic index suggests economic activity will continue to decelerate in the months ahead and forecasts that the U.S. is likely to be in recession from the current quarter to the first quarter of 2024. But we've been saying a recession is coming since last year, so we'll see if it actually comes. Now, earnings season is in full swing, so here's a brief overview of how things are looking for some companies.
Tesla is among big names to report numbers this week as global earnings season gets into full swing. And so far the figures make grim reading for investors. The US EV maker was just one to disappoint. Its shares sank around 4% in US pre-market trade Thursday, after boss Elon Musk said late the previous day that he would do more price cuts to stimulate demand. Chip-making titan TSMC added to tech sector woes. The Taiwan firm forecast a 10% drop in sales this year, saying demand for chips looked weak across numerous sectors. European results were no better. Home appliances giant Electrolux said Thursday that it had swung to a loss. It says cash-strapped shoppers are switching to cheaper products. Shares in the firm tumbled over 15%, on track for their worst day in 12 years. ABB, seen as a bellwether for industrial firms, also said demand was weak in markets like China and Germany. High interest rates and inflation are among the common factors behind the gloomy outlooks, with consumers around the world feeling the pinch. Overall, earnings for companies on Europe's Stock 600 index are now forecast to drop over 9% in the second quarter. That would be a big downturn from 11% growth in the first 3 months of the year. A similar drop is expected for US firms.
And here's some quick takeaways from Netflix's earnings report. It added 5.9 million subscribers in the quarter. Now, heading into the earnings report, investors were curious how much the company's crackdown on password sharing would boost subscriber growth. Well, seems like now we know, and the numbers did not disappoint. Now, this is just 1 year after it had lost nearly 1 million subscribers. The streamer boasted that signups are already exceeding cancellations, and that it's implementing the password policy across the world now. But Netflix did narrowly miss on revenue, with its stock 8% down in after-hours trading as Wall Street remains concerned about streaming profits that are plaguing the industry at large. In other news, only one ticket in the entire country matched all 6 Powerball numbers drawn Wednesday night. The winning ticket for the billion-dollar jackpot hails from California. NTD's Christina Corona spoke to the co-owner of the store that sold the ticket.
Well, it's happened again. The $1 billion Powerball winning ticket was once again sold here in California. Las Palmitas Mini Market in downtown LA is filled with excitement and joy.
The numbers from Wednesday night's game were 7, 10, 11, 13, 24, and red Powerball 24. Las Palmitas Mini Market will now receive a bonus of $1 million from the California Lottery. We spoke with Angelica Menjivar, the co-owner of Las Palmitas Mini Market, who shares her joy about selling the winning ticket.
We find out happy, excited, but I think that we are more excited for the winner. Yeah. Winner, winner, winner. So congratulations to the winner. We don't know if it's a girl, boy, guy, lady. We don't know yet, nothing. But I feel that she or he will be so happy with this.
Angelica told us her mom owns the convenience store and what their plans are with their $1 million bonus.
Oh, she's really humble person, so she's like really happy too. So we are, as a family, we are so happy. No, we don't have any plans yet. I think so life is keep going, so like any normal day, so keep going, life is easy, so keep going and moving on, that's it.
Lottery officials said on Thursday morning that the mystery winner hadn't stepped forward to cash in the ticket yet, but has 1 year to claim the prize.
We're standing here today wondering if the person who bought the ticket even realizes it yet. We won't know at the lottery, the public won't know until somebody comes forward and claims that prize. So they have to claim the prize and then go through a vetting process at the California Lottery to ensure they are the legitimate winner.
If the winner chooses to take the lump sum, the cash value of the winning ticket is $558.1 million before federal taxes. This Powerball jackpot eluded players for 3 months before it was finally hit in the 39th drawing of the jackpot run. This was the 3rd largest Powerball jackpot and 6th largest U.S. lottery jackpot ever won.
Las Palmitas Mini Market struck luck when their store sold the $1 billion winning Powerball ticket, turning their small business into a celebrated destination overnight. Christina Corona, NTD News, Los Angeles.
And here's what to do and what not to do if you do win the Powerball. Here with me is Lawrence Sprung, wealth advisor at Midland Financial. So apparently somebody just won $1 billion in the lottery. I gotta say I'm a bit jealous, but I just want to know, just in case I win in the future, right? What are the do's and don'ts? I mean, quitting your job immediately and telling everybody, good idea or bad idea.
Yeah, so thanks, Don, and great question, and I'm here with you, so clearly I did not win either. So otherwise, I'd probably be speaking with my attorney right now. So to go into that, do's and don'ts. So I think the good rule of thumb is to keep things status quo for the time being. Make sure that you're not making any major lifestyle changes until you know how this is going to impact you and your family if you have a family, right? So a couple of the first people you would want to talk to are your accountant, your legal advisor, your legal counsel in terms of how to accept perhaps that those winnings, and a wealth or financial advisor. I think those are going to be 3 key people that are going to be important in helping you navigate, actually receiving the money, the tax ramifications associated with it, and then how to position that money for the future for you and your family in a way that's going to be most beneficial to you.
So basically, you shouldn't just go out and buy a $100,000 car.
I wouldn't. I mean, certainly, you might want to make sure that you got the check in hand and that the numbers are actually a match and then the ticket is verified before you go spending the winnings. And keep in mind, there's going to be huge tax consequences as a result of winning the prize. And then there are many different ways, right? You could either accept it in the form of an annuity payment or a lump sum. So that's also going to change things, very much so in the way that it's a large sum of money. So chances are, if you do the right things and set yourself up in the right way financially, you will be set for life if you win $1 billion as an individual, and you'll probably be able to set up your family for even multiple generations to come if you do things right. I think going out and spending, significant dollars on a car, for example, may put you in a position where you're on an unsustainable path that you don't want to go from winning the $1 billion lottery and being on TV and then being on TV on one of those shows showing you how you won $1 billion and then it went to zero in 10 years either, right?
So yeah, you gave us a couple of tips, but what's the concern here? If you don't do this right, what's the consequences?
So there are several consequences. One is obviously you can run through the money quickly. And I know that's hard to even imagine, running through $1 billion, but once people know that you have won this lottery, people are going to come out of the woodwork. And, that's a significant way that we see people losing wealth is friends, family, acquaintances come out of the woodwork. They need some help. So you have to be careful about that. You want to make sure that you're structuring it properly and you're protecting yourself. There may be, depending on your state, there may be legal constructs in terms of how you accept that money. I'm not a lawyer, but there are legal constructs on how to accept the money in order to shelter it from potential liabilities or potential what we call creditors or predators. So there are a lot, when you go from a situation of being an average Joe to having $1 billion, you're basically putting a target on your back, and you want to do this in a strategic and thoughtful manner and in a way that's going to provide you with as little fanfare, believe it or not, as you possibly can.
So is it true or is it a myth that if you win the lottery, you shouldn't tell anybody?
Well, I mean, my understanding is in some states that, depending on some states where you win the lottery, you're giving them the ability to share your name and likeness. So you might think that that's a great plan. And I would agree, it's probably not a bad idea, but in many situations, they're going to release who you are and it's going to be public. They're going to use that, use you and your winning as a marketing tool to sell additional lottery tickets. But, if you think about it, when people have a windfall, all kinds of people come out of the woodwork when that happens. And the quieter you could keep it, the less impact that's going to have on your situation.
And what about buying an expensive house? I mean, that's something that everybody wants, right?
Yeah, well, I mean, as I talk about in my book, Financial Planning Made Personal, it's very personal. Some people, I'm sure that definitely applies to, others maybe not. But you gotta keep in mind, maybe with $1 billion situation, lottery winnings, it's not as impactful or worrisome. But in other cases, you have to not only think about the purchase price and the cost of the house, that's how much it's going to cost you to get in, but you also have to keep in mind, well, what are the taxes going to be, the real estate taxes? Because depending on that burden, that's a burden that's not going to go away. It's going to continually be there and rise every year. What's going to be the upkeep of this home? So when you start thinking or talking about making these large purchases, you have to think about what the longer term ramifications are going to be, and if you're going to have the income or the assets to continue to support that. Now, with $1 billion, you very well may, if you structure things and set it up properly. With some smaller lottery winnings, it's clear how people get in trouble, because if they go buy that house not thinking about the taxes and the upkeep, they can end up in a precarious situation as a result.
Yeah, exactly. Just one final question. You talked about a number of things, but the very first thing to do, as soon as you get that money in your bank account or wherever, the very first thing to do, what is it?
Well, I would even take it a step back, Don. Before the money is in your bank account, I would connect with and have a conversation and get that team of those three individuals together. Your accountant, whoever that may be, and if you don't have one, find a very good one. Your lawyer, if you don't have one, find a very good one, and your investment or wealth advisor or financial planner. Get those three people together in a meeting before you even accept the check to start educating you and walking you through the best process in order to take possession of the check, and then what do you do from there?
Well, all right. Maybe they should come to you. I don't know. Well, but thank you so much today, Lawrence.
Thank you, Don. Appreciate it.
The U.S. Federal Reserve has launched a long-awaited service which will aim to allow everyday Americans to send and receive funds in seconds, 24 hours a day, 7 days a week. The service is called FedNow, and it's going to seek to eliminate the several-day lag it commonly takes cash transfers to settle. FedNow is launching with 41 banks and 15 service providers certified to use the service, including community banks and large lenders like JP Chase. There's a difference, though, between FedNow and peer-to-peer payment services like Venmo or PayPal. Peer-to-peer payment services act as intermediaries between banks, but payments made via FedNow will directly settle in central bank accounts. FedNow will not charge consumers, although it's unclear whether or how participating banks will pass on any costs associated with the service. Brands and retailers are hoping cautious consumers will spend their money on Barbie-themed merchandise amid rising popularity for the movie. Here are the details.
The business of Barbie is hot pink. This summer's blockbuster Barbie movie has retailers and brands rushing to cash in on the nostalgia.
I'd say the world has turned pink. It's an incredibly important milestone for the brand.
Retailers are hoping cautious consumers will dip into their discretionary spending to buy Barbie-themed merch. More than 100 eager companies, including Aldo, Gap, and Crocs, have signed deals with Mattel, the maker of the iconic doll, to create and sell Barbie-themed clothing, shoes, accessories, and countless other products, including the doll herself.
I think I had 24.
24?
And they were gone within I'd say within 48 hours.
In New York City, Bloomingdale's flagship store, a pop-up shop looking more like Barbie's dream house. Meanwhile, Mattel is also hoping the new film will give Barbie sales a boost after sales in the first quarter of this year fell 22% compared to the same quarter last year.
We anticipate that this is going to be an unlock moment of huge monetization potential for the Barbie brand.
It comes as higher grocery prices have impacted consumer spending. Retailers are hoping the pink craze this summer can chase away the inflation blues. Experts say it gives retailers a creative opportunity to lure in frugal shoppers into their store and convince them to spend their cash.
I've seen, more diversity, like in terms of dolls in general. So I would say there's an effort.
Could it soon get harder to receive a package or take a vacation, perhaps, or see new TV shows and movies? Here are some potential strikes that could or have taken place already.
Labor strikes could soon make it harder to order packages, take a vacation, or enjoy some entertainment.
We know how much money UPS makes because we literally make it for them every day.
Members of the UPS Teamsters Union are staging practice picket lines.
We want to sit at that dinner table. We help put that turkey on that table. Just give a seat. Give us a seat.
American Airlines flight attendants are set to vote on a strike authorization this month. Their union's negotiating for an immediate 35% raise. That's in line with what United, American, and Delta have offered pilots. And in Southern California, hotel employees have been staging short-term walkouts over pay and benefits. Meanwhile, Broadway workers could go on strike as soon as tomorrow. Members of the International Alliance of Theatrical Stage Employees are voting through today on whether to authorize such a walkout. And in Hollywood,
technology cannot replace an actor, full on.
Unions for writers and actors say streaming services are undercutting their pay, and they want restrictions on AI.
Now, as it relates to writers, I think they can more easily be replaced by artificial intelligence.
More bankruptcies may be coming for American companies. Over $100 billion of U.S. corporate debt are trading at distressed levels, rarely seen in the last decade. And here to talk to me about this is Tavi Costa, portfolio manager at Crescat Capital. Some potential strong headwinds facing the economy is the amount of debt. I want to start off with corporate debt. Currently, many companies are locked into low interest rates, but refinancing wall, so to speak, could be coming up. So, we have to respect the lag effect of the Fed's interest rate hikes. I just wanted to get your thoughts on how much of a headwind are we facing, because the U.S. is very much leveraged on many levels.
Yeah, overall, the corporate debt relative to GDP is not as pronounced as you would think. However, there are companies that have issues, and there are companies that I like to say, for instance, that are a lot of business models that would never work in a 70s environment, not because of the world being different, but just because of the cost of capital being drastically higher. And we're seeing structurally higher interest rates in general, especially across corporate bonds. And if you looked at, for instance, of a chart of junk bond yields and so forth, not credit spreads itself, because every yield has been moving higher, essentially, not only the treasury yields, but also corporate bond yields. And so, like you said, a lot of companies are going to have to be either restructuring their debt, like Carvana did yesterday, and the stock popped on those news and so forth. But not a lot of companies will have the fortune to have, some sort of alternative to clean up or make their balance sheet look better. By the way, by no means I think Carvana did a great job at that either. I disagree with the market reaction. But I think some companies will have those alternatives. Majority of the companies that are highly levered are in big trouble, and their businesses are in big trouble. And so as a money manager, I think you want to be seeking to parts of the market that can provide you that exposure on the short side. We've been looking for companies that have, average maturity debt that will be, in 1 to 2 years out, meaning they're going to have to roll their debt in 2 years or so. And there's a significant amount of those with negative free cash flow, already into the junk status. I think there's going to be a lot of issues with that. I can't imagine a company losing money on a free cash flow basis consistently for the last 5 to 10 years or so, also having to restructure the debt at a much higher interest rate. And so remember, 15 months ago, the Fed funds rate was 0. So things are going to have to be readjusted in a big way here. Now, maybe even credit spreads are going to have to blow out. Maybe even the VIX is too low and things like that. I think there's a lot of instruments that are very suppressed historically. That for a money manager, those look really attractive as a way to kind of hedge your long side of a portfolio.
And I wanted to talk to you about the debt from the government side as well. But before that, just one question about, are we going to see more bankruptcies then in the future? I would imagine the scenario you just laid out could result in that.
Yeah, it's going to be bankruptcies. It's going to be geopolitical, tensions, meaning debt creates problems, right? Overwhelming levels of debt. And then you have interest payments is starting to increase relative to what a company makes, what a country makes. You start seeing some populist agendas, not only from a countrywide manner, but also from even the business side. You start seeing protests as people not being able to, to live in an environment where cost of living is so high, and they start pressuring companies to pay higher wages, and then companies have to squeeze their margins, but they're already holding a lot of debt. So yeah, eventually you see, companies that used to make sense in terms of a business model being appropriate for that environment, not be appropriate anymore. And it's interesting how a lot of investors still operating with the mindset of high growth and low cost of debt and setting that we've had over the last 2 decades, or 3 or 4 really. But I don't think that's going to be the case. I think again, structurally rates will be higher. Businesses that work in the past will likely have issues. They're going to have to change the way they operate. There are going to be other companies that are, that already have been profitable, that nobody cared about profitability in the past, that will have to be rewarded for that level of discipline. And so a lot of things are changing in that side as well.
And if companies are less profitable, that also means less revenue, tax revenue for the government, which leads into this next topic is the amount of interest rate, the amount of debt that the government has is very much impacted by the Fed's rate hikes. I mean, this is the most aggressive campaign since the 80s, but it's different this time because the amount of debt now that we have it's much higher than before. So it has a much bigger impact, coupled with lower tax revenue. I mean, what are we looking at here?
Yeah, I just posted a chart of interest payments, for instance, in the U.S. and the government debt being higher than defense spending annually. So you're starting to see the rise of some parts of the agenda not keep up with the rise of the cost of debt itself. And what is important is that we have a monetary and fiscal policy dissonance, meaning there's a divergency between the way monetary and fiscal authorities are leading with the issues that we have in the economy, and that is completely unsustainable. You can't sustainably raise cost of debt at a time when there's no enough buyers of U.S. Treasuries. So when you look at the debt that the Federal Reserve owns by the government, which used to be close to about 30% or so, it's down to almost below 20% now. It's been plunging, meaning we're issuing a lot of debt and the government's actually not buying them, and they're actually shrinking their size of their balance sheet. So something has to give. At the same time, you look at interest payments, they're surging to the upside. And what we know is, number one, there's debt issuances happening. And so you want to look at a country like you look at a company. And when you see what's happening from a kind of a income statement of the U.S. today, what is the income statement of the U.S.? Well, that would be what you just said, the deficit itself, meaning how much they can collect versus how much they spend. And second would be what's happening with the current account, so how much they are exporting versus importing. And so this has a huge impact on how the debt gets paid over time. And what we're seeing today is basically almost the twin deficits, meaning we have a deficit in the current account and a deficit in the fiscal account together. That's called a twin deficit. That is as severe as it was in the very worst parts of the global financial crisis. And so that is just compounding the debt, in a very severe manner. And remember, when we left the COVID problem, not too long ago, basically what caused in that period was, I think it's the beginning of an era of fiscal dominance, of especially across the G7 economies, the developed places, and so forth. And that is creating, if you looked at how much the government in the U.S., even if you exclude interest payments today, the government in the U.S. is spending close to 23% of GDP in fiscal spending. And so, which is much higher than any other time in history. The only other times you see such a high level of fiscal spending, again, excluding interest payment, was coming out of the global financial crisis. Today, it's higher than that. And so, we're not even in a recession. How can the economy not be booming when we have 23% of GDP being spent on fiscal today? And so it's really weird. I mean, if you think about what's a healthy economy, just my final thought, is an economy that is growing tax revenues and declining fiscal spending. We have the complete opposite of that today. We have a declining or plunging, tax collection relative to GDP. And also, if you look at the fiscal outlays or the fiscal spending, it's also surging. So, that is why we're seeing a pressure in 10-year yields to rise, and why I continue to think 10-year yields will continue to go higher.
I think another aspect of this, why we're not seeing higher GDP numbers, is the amount of people that's actually working in this country. Unemployment is at 3.6, 3.5, 3.6. But that's only counting the number of people that's actually working in the economy. If you look at the entire population, if you counted every single person here in the U.S., you would have a much higher number of people who are not working, and that doesn't contribute to economic prosperity. What are your thoughts on that?
Well, I just think that it's, we're operating in a different macro regime. And so thinking that low unemployment rate perhaps is a reflection of a healthy economy, let me pose a different view about this. If you're living under circumstances where your cost of living has risen significantly from your rent, from what you pay in grocery shopping, what from your gas prices and so forth. If everything is higher for you, and obviously you're going to be forced to go back to the labor market. If you're not in the labor market, you're coming back to the labor market immediately. So participation rate is rising, to ways that we haven't seen in many decades. And then you look at even the need for people to get jobs is also rising. And I would say what you're seeing is the lower income parts of the societies are really what's driving the strength in the labor market. It's pretty clear that that's the case. In fact, I think 10% or 11% of job openings today are actually coming from government job openings. So, it's the largest amount of that represents the overall job openings coming from government that we've seen every time we have a recession, because other private businesses cannot keep up with that. But the government usually hires more people during turmoils as well. So, so you're seeing that as well in terms of the problems in the labor market. So the labor market is I think people are reading it the wrong way. And Bryn, don't forget, you talking about the lagging effect of the Federal Reserve actions. Well, the same goes for the labor market. I think we could see unemployment rates rising here soon, but we do have to kind of clean up that job opening side, which is mostly driven by the need for small businesses and so forth. They're still looking for folks, and a lot of people in that part of the society are asking and demanding higher wages as well. So that's why I think this is different than we saw in 2008. This is very inflationary at its nature. It's very similar, to an emerging market where you have very large social programs targeted to the low income folks. And unfortunately, there's a lack of discipline underlying in those parts of the society where they spend more capital than what they have, so relative to what they have. And so what you tend to see is the upper pressure on goods and services. And so, I think there's, this is very different in 2008 and even the early 2000s during the tech bust.
Okay, just quickly, one last question. We're talking about government debt, and perhaps it's not unsustainable. But as long as there's confidence in the U.S. government, then there's no problem, right? Are we going to see a drop in confidence?
Well, I think if people are not seeing the accumulation of gold by central banks, which basically is a metric to look at confidence on the U.S. relative to how much they've been buying of treasuries, it's really interesting, right? Everyone is sort of, emphasizing or prioritizing a need to own a tangible asset that is neutral, that also enhances the quality of your international reserves, not treasuries. And so if you look at the percentage of holdings by foreign institutions of treasuries relative to the overall debt, so we're basically seeing one of the largest issuances of debt in history. And who is going to be buying those things over time? How will the Fed not be forced to step in? Some people call that yield curve control. Some others are, they can have a lot of names for it, but it's really odd what's going on in terms of the size of those issuances. Somebody's going to have to step in. I don't think the market itself, it's almost like the Fed needs a deflationary shock in order to create a demand for treasuries. That's really what it needs. Otherwise, it's going to have to just come in and be the buyer of last resort. So I think central banks ultimately are going to reassume their very important role as the main financier of government debt over time. And this is why it kind of think about all those policies and why they're so constrained. It comes back down to owning tangible assets or underlying businesses that have tangible assets as their goods. And therefore, I think those are going to be the ones really striving in this cycle.
All right. Thank you so much today, Tavi. Always great speaking with you.
Thanks for having me.
And to end today's show on a lighter note, watch this basketball shooting AI robot.
Hello, sports fans. Get ready for the clash of the titans you never knew you needed. It's a world-class NBA shooting pro versus an AI-powered shot-shooting robot in what's sure to be a hoop-tastic throwdown. Isn't that right, Jim?
That's right, Phil. Chris Matthews is an expert NBA shooting coach who traveled to Japan to take on this shot-calling b-ball and bot designed by Toyota engineers. The robot, called Q6, is powered by artificial intelligence and actually set a Guinness World Record by sinking more than 2,000 consecutive free throws, Jim.
Well, Phil, the bot's got game, but Matthews has a decidedly human trait, trash talking.
See what you got, Q.
Even though the dead-eyed droid took down the first round, in the end, this man versus machine match was called a tie.
Uh-oh.